Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good afternoon. Today will be Thursday, the 13th of February 2025. So let's have a quick look at the disclaimer first before we jump straight into today's gist of the Daily Dose. Right, so leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a recap what has taken shape yesterday, because yesterday's there are various key events that drive the intraday price movement, and potentially this intraday price movement could actually create a persistency of trend at least for the next 1 to 2 days. So what has taken shape yesterday is number one, firstly is the release of the all-important US CPI data. Why is it important? Because it drives the US Federal Reserve monetary policy guidance, which potentially impact all cross asset classes. So let me share with you the data point for the CPI data yesterday. So hopefully you guys could see my screen. Okay, it should be able to see right now. Good, yeah. So what you could see over here is that yesterday CPI data actually surprised on the upside. So if you look at the core inflation rate, that's excluding the energy and food prices, actually rose higher than what market is expecting. So market consensus is penciling 3.1% year-on-year increase for January, but it came in at 3.3%, 2 basis point higher. I would say that 0.2% higher than what market is expecting and 0.1% higher than the previous month of December. So if you look at the trend over here, it seems to be in the month of September last year, it has started to stabilize. That means, i.e., inflation is not inching downwards as desired by the US Federal Reserve of hoping to look for an inflation rate of stabilize it at 2%. And if you look at the 3-year trend, it seems to have started to form a potential basing formation in August, September last year. All right, so initially how the market reacted, the market saw dollar strength coming back into the picture. Dollar actually rallied. So you look at the 5-year 5-day rolling performance of the US dollar against the major currency, the dollar rallied. Then thereafter, after the dollar rallied, it starts to actually plateau off. That means the dollar strength starts to get abated during the second half of the US session, or at the start of the second half of the US session. And the one that is performing pretty much strongly will be the dollar yen. So the dollar yen hit the upper limit of our neutrality zone yesterday at the 154.15, 154.50 level. So later we'll touch more about that. And what we could see over here is that the US CPI data that was rather hot caused the dollar to rally. But why does it plateau during the start of the second half of the US session is based on one statement made by the US Federal Reserve boss, which is Fed Chair Powell. So we know that Fed Chair Powell yesterday was his second testimony to Congress. So yesterday he actually addressed his testimony to the House instead, right? The first day was Senate, that was in Tuesday. So yesterday he addressed his testimony to the House. So no change, right? He actually did mention over here his remarks. Okay. So Fed Chair Powell, his second day holdings in Capitol Hill. So what did he mention over here is that Powell told the House Financial Services Committee, which is the House, that the data was further evidence that this data means that yesterday's rather higher than expected US core CPI data further evidence that the Fed battle with rising prices wasn't finished, and mean further rate cuts will have to wait until it is clear for inflation to return to the Federal Reserve 2% target. All right. So, and eventually, what did he mention over here is that where is it? Because I want to highlight. Because he mentioned that they are looking at the piece. Yeah, this one. Okay, yes. So he did mention that he cautioned that a month's bad data shouldn't be taken as a signal that progress on inflation is reversing. And noted that the Fed sets its 2% inflation target using a separate CPI inflation indicator where they watches the PCE, which is in long form the Personal Consumption Expenditure Index (PCE) that typically runs lower than the better known CPI. So because of this messaging to the House members, the market interpret that number one, yesterday's CPI data is not that hot as being portrayed by the initial thoughts, and that also causes the US dollar strength to shape that setback. All right, and eventually we start to see the major US stock indices also rally as well towards the close of the US towards the later part of the US session. Right over here, it rally up, and we start to see initially the S&P 500 has an intraday loss of negative 0.7%, and this intraday loss has starts to lessen to end yesterday US session at negative 0.3%. The Nasdaq managed to inch up higher thanks to various mega cap technology stocks, and it managed to actually from a loss of negative 0.7%, it managed to gain up to 0.12%, all thanks to Apple and Meta, and as well as Tesla. These three big mega cap stock. Tesla up by positive 2.4%, Apple up by 1.8%, and Meta, Facebook up by 0.8%, and that causes the Nasdaq 100 to record a small gain by the close of the yesterday US session. Underperformer will be the Dow Jones Industrial Average down negative 0.5%, and the Russell 2000 down negative 0.8%. All right, so and what we could see over here is that during the intraday session as well, yesterday there was also a positive geopolitical news flow where actually Putin and Trump, based on the phone call, agreed to Ukraine talks over here. So because of this, potentially the ongoing conflict between Russia and Ukraine may soon come to an end. That means there could be some signs of potential peace talks after Trump and Putin conveyed via telephone yesterday. So with that, that also causes the euro to actually rally. So you know that the euro has a close proxy with this geopolitical risk tension between Ukraine and Russia, and that also saw the dollar strength to actually set back as well during the later part of the euro session, during the later part of the US session, where the dollar now is the weakest against the euro, followed by the sterling dollar. And because of that potential peace talk between Russia and Ukraine, that reduced geopolitical risk tension, and that potentially also starts to see energy prices in in the European situation starts to thaw as well, because don't forget Russia still controls some of the gas supply, so the gas supply will now start to flow more normally in the European economy, and that has a negative feedback loop into the WTI crude oil price, where we start to see WTI crude oil price decline by negative 2.6% yesterday. Right, because of this potential peace talk breakthrough between Ukraine and Russia. All right, then thereafter, gold price continues to trade sideways yesterday with a very tight sideways range. So later I'll touch more about gold and West Texas crude oil when we cover the intraday technical outlook segment. All right, so this is the things I want to share with you guys. Now, on the longer term basis, now I'll touch on more on the longer term fundamentals. So on the fundamentals, yes, despite the fact that we start to see this kind of soothing messaging from the US federal boss, Fed chair himself, saying that he's not bothered by the uptick in the US federal the US CPI data yesterday, because he's looking at another indicator called the PCE, which tends to run much lower than the hotter than the what you call it price uptick in yesterday's CPI data. But market in certain instrument, especially the fixed income instrument, doesn't think that wise. Why? They doesn't think that in line with the US Federal Reserve Fed Chair Powell statement yesterday. By looking at the break-even rates. All right, so this break-even rates is actually market transacted based on the US Treasury inflation protection security. So if you look at the break-even rates, it's actually rising very steeply. The 5-year break-even highlighted in dark green and the 10-year break-even highlighted in light blue. Both of them are up 2.67% and 2.5%. So these are things that these are actually imply future inflation expectation rate from today. That means what is market expecting 5-year inflation rate from today and 10-year inflation rate from today. So the 5-year inflation rate expectation from today based on the break-even rates as being derived by the US Treasury protection securities. Inflation protection securities is up by 2.66% for the 5-year. The 10-year is up by 2.46%, and these are the highest level since in almost 2 years. And they actually diverge very significantly from that elusive 2% inflation target that the Fed wants to achieve. So what it means that over here is that potentially markets in the fixed market participants in the fixed income market starts to have a realization that the Fed got to be less dovish this year, and that doesn't pick up by the FX market and the stock market yesterday because they are driven by other factors as well. Optimism in the Ukraine and Russia peace talk breakthrough, and also being optimistic about hearing Fed Chair Powell one particular statement saying that he's not bothered by this yesterday's uptick in yesterday's US CPI data. And what's interesting also, the Fed funds futures market participants, that means this is market participants betting on whether the Fed will be dovish or whether the Fed will cut, hold, or whether the Fed will cut, hold, or increase Fed funds futures in Fed funds rate in the upcoming meeting, also represents a less dovish Fed as well. So if you look at the current Fed funds futures market pricing based on the CME Fed Watch 2, high chance that the Fed will not do anything on 19th of March. That will be the next FOMC meeting to maintain the Fed funds rate at 4.25% and 4.5%. Why? Because it's a high probability of 97%. And if you look at the aggregated probability, where we look across the different Fed funds futures contract that is tied up to the various future meeting dates down the road, means all the way down to 2026. So what we could see over here is that the dovishness has started to reduce the dovish expectation. Why? Previously at the start of this week, there is a high chance of about close to 60%. The market is expecting the first cut to come in June, 18th of June 2025 FOMC meeting. But however, this chance has been greatly reduced to below 50% to only 40%. And now the next chance slightly higher than 50%, only not that high because it's at only 56%. It will come in 30th of July. And the highest chance, the higher chance at 83% will only come in September. So the market is now pushing down the road that the first cut may come in later in either July or September FOMC meeting. And that very small chance of about 50% plus that another cut will come in before 2025 end on the 10th of December 2025 FOMC meeting, that has been totally eradicated because now market is only looking at 21% chance the Fed will do another potential interest rate cut to bring down to 3.75% to 4%. So what market is pricing in right now is only a chance of one interest rate cut before 2025 ends, and thereafter the market will start to price that the Fed will remain on hold all the way until 9th of December 2026. There is a 55% chance the Fed will do another interest rate cut. So what we could see over here is that there's a swing of pendulum that market participants in the fixed income market, both from the US Treasury inflation protection security, that's where I derived the 5-year break-even rates and 10-year break-even rates just a while ago, and the very short-term Fed funds futures market. The market participants in these two markets is going against the expectation of the market participants in the stock market yesterday, US stock market yesterday, and as well as the FX market. So what we could see over here is there's still risk that the Fed will be less and less dovish in 2025, and potentially the stock market and the FX market participants will tend to revert back to normalcy. That means the US dollar strength in the medium term is rather still intact, and as well as the US stock market may see a shock of a risk of sentiment because a less dovish Fed implies the longer term of the fixed income market, especially the US 10-year Treasury yield, starts to shape a bullish breakthrough yesterday above their above its 20-day moving average yesterday, a very clear bullish breakthrough, implying that this major uptrend phase continues to resume since the low of September 2024. So what you means that the 10-year US Treasury yield is being used as a risk-free rate to benchmark long-term cost of financing. If long-term cost of financing keep on increasing, it may potentially reduce net profits of US corporation, and that hasn't been picked up by yesterday's stock market participants based on the intraday movement of the major US stock indices. But however, on the intraday basis, we got to respect momentum rather than fundamental. Sometimes momentum actually overrides fundamental, where we got to be aware of when I touch on the intraday technical outlook. So this is the fundamentals that I want to share with you guys right now. That's important. Now, let us now kickstart our intraday technical outlook, starting with the FX market first. All right, so before that, let me, as usual, expand my screen so that you guys could have a better view of the charts itself. Okay, so hopefully you guys could actually see right now. Okay, give me a couple of seconds. I think it's a bit hang right now. Okay, give me a couple of seconds more. Okay, I think everything should be fine. Okay, you guys could see. Okay, now let us kickstart the FX market first, the short-term intraday technical outlook on the FX market. All right, starting with the euro dollar. So what I could see over here is that the euro dollar continues to pierce higher. So yesterday we have a bearish bias hitting our first support level that we highlighted at 1.0330, 1.0350 level. It hit, then thereafter it did a V-shaped recovery. So this V-shaped recovery further was, number one, the bounce was being triggered after Fed Chair statement that he mentioned that he's not bothered by yesterday's uptick in the US CPI data, which I covered in the earlier segment of the news flow, and further rally up further when there's this Trump and Putin conversation breakthrough, stating that potentially there could be peace talks between Russia and Ukraine in the near-term horizon. That causes a further uptick in euro dollar as well. And we got to respect this uptick because it managed to broke above the 50-day and the 20-day moving average. So what I could see over here is that the euro dollar right now on the very short term may potentially now see a push up towards the top of the range at 1.0530. So with that, I'll be using the first support level to watch will be yesterday's higher low here. This low is higher than this low, which is at 1.0850, but I don't put it so tight just in case of the whipsaw. Use it slightly lower at this 1.0360 level. All right, 1.0360 level. At 1.0360 level also pretty much correspond to this minor ascending trend line, taking into the low of minor low of 3rd of Feb, connect it to the low of 11th of Feb over here. Okay, and it also corresponds pretty much closely to this level as well. So what you could see over here is that I'll be using a rather tight short-term pivotal resistance support level for today at 1.0360. So as long as any minor pullback didn't surpass below 1.0360, we will flip to an intraday bullish bias within a range configuration. Above 1.0460 exposes the top of the range at 1.0530 for the euro dollar. Only a breakdown below 1.0360 will invalidate today's intraday bullish bias to see it floating down to the bottom of the range, exposing the next near-term support level at 1.0330, followed by 1.0270 next. All right. So to give you all a better perspective, right? If I look at the daily chart over here, this is the daily chart. So what I could see over here is that previously there's this broad-based medium-term downtrend from the high of 25th of September all the way to the low of 13th of January. And there was a retest of it on 3rd of February, just this month, start of this month. Then thereafter, price action starts to trade sideways. So what I could do over here is that in terms of the either way perspective, is now potentially complete 5-wave down. Okay, 1, 2, 3, 4, 5. And what we could see now is a ABC correction to retrace this 5-wave down formation. So in the next couple of days or even weeks, we may see a lot of choppy price movement of the euro dollar as it continue to trade within this kind of sideways range configuration, pretty much complex range configuration. So it could be in a form of symmetrical triangle, ascending triangle formation until the price action gets more clearer. All right, but we know that the daily RSI is rather positive right now because it managed to came down, bounce off from this parallel previously descending trendline resistance, now turns into a pullback support, and recently yesterday it just broke above the 50 level and has yet to hit the overbought zone. All right, so from a very short-term perspective, that means when we talk about multi, because this daily chart, so we talk about multi-day, potentially maybe multi-week, there could be some form of what I call corrective rebound sequence taking shape to retrace the 5-wave down movement of that previous medium-term downtrend that likely to have ended from the low of, from the high of 25th of December all the way down to the low of 13th of January this year. But however, the longer term picture is still pointing towards a major downtrend phase, longer term. Because why? Because it broke down from the previous major range configuration of 13 18th of July all the way up to 25th of September 2024. That was almost a year. Then after that, it broke down during the early part of November last year. Okay, so this is something that I'll share with you. If you look at from a longer term perspective, that number one, the euro dollar major downtrend is still intact. It's only the intraday sequence over here. We may see a bit of bullish momentum as it tries to actually now transform into a potential corrective rebound phase from a multi-day to multi-week perspective, and that also starts to see a positive follow through in the sterling dollar as well, because we know that the sterling dollar and the euro dollar tends to track closely together. So for the sterling dollar yesterday, we also have a bearish bias. It hit the first support level at 1.2380 before shaping that V-shaped recovery, and right now it's attempting to break above the 50-day moving average as well. So with that, I'll be using yesterday's swing low as my 1.2380 level. This will be my short-term pivotal support level, and we will flip to a intraday bullish bias for the sterling dollar for this corrective rebound phase to face out. And you look at the sterling dollar right now, is trading within a bearish ascending triangle ridge configuration. That means we start to see a higher, this line here, sloping upwards, this line is sloping upwards, but the slope of the upper boundary is lesser than the slope of the lower boundary. So this is what I call a bearish ascending wedge like triangle formation. It's also a corrective rebound sequence to retrace the previous medium-term decline that has taken shape since the high of 27th of September. That means the medium-term downtrend from 27th or 26th of September last year all the way down to the low of 14th of January has ended. And based on the Elliott wave perspective, now is doing this kind of corrective rebound sequence that could potentially last from a multi-day to multi-week perspective, as the price action going to involve in this very clearly the bearish ascending wedge like formation. At the up of the wedge will be at the upper boundary of the wedge will be at 1.2580, 1.2560 right now. So with that, we will flip to a intraday bullish bias using 1.2380 as my short-term pivotal resistance level. A breakout above 1.2490 potentially sees the upper limit of this bearish ascending wedge resistance coming in at 1.2580/1.2610. Only a breakdown below 1.2380 potentially sees a slight down to retest the lower limit of this bearish ascending wedge that is acting as the next near-term support at 1.2325. Only a breakdown below 1.2325 potentially sees a bearish breakdown of this bearish ascending wedge formation to re-expose the next support level at 1.2240. So i.e. in a nutshell, I'll be flipping to a intraday bullish bias within this bearish ascending wedge formation that is still evolving for the sterling dollar to retrace its former put it away that to undergo this corrective rebound of its former medium-term downtrend that may have ended recently from the low of 13th of January. So using 1.2380 as my short-term pivotal support level, and we are now to actually maintain this intraday bullish bias on the sterling dollar. All right, so with that, now let us turn our focus now towards the Aussie dollar over here. So the Australia dollar continues to actually evolve in a very sideways range configuration. So yesterday we have a pivotal resistance level at 63.30, and right now it actually inched downwards towards 64.40. That was expected as well. in yesterday's intraday technical outlook, where we have a bearish bias within this sideways range configuration. And given the strength of the sterling dollar and the euro dollar, I do not have a very strong conviction of a bearish bias on the Aussie dollar. So with that, I will have a neutrality stance for today on the Aussie dollar. So neutral between this 63.30 level over here, and the lower limit will be yesterday's minus swing low of the Aussie dollar that it managed to survive the sell-off, right, during the US session, ex-post US CPI data release. Okay, let me put it in writing. Whoops, sorry, let me put it in writing again. Okay, so yeah, so neutral between 63.30 and 62.40/62.25 on the Aussie dollar for today. All right, now with that, let us now turn our focus to the dollar yen. So the dollar yen yesterday, we were neutral. It hit the upper limit of the neutrality zone at 154.50 level, and also the 20-day downward 20-day moving average. So what I could see now is that the hourly RSI has been in the overbought level. He hit overbought, and very interestingly over here, if you could to shape a parallel trend line support level, is now breaking below this parallel trend line support level right now. Okay, so this one called parallel because it links together with the higher low on the price action, but the RSI has starts to now shape a potential bearish intraday intra session bearish breakdown right now as we are speaking. And it starts to also where this bearish breakdown take place after it tests the upper limit of yesterday neutrality zone, which is at 154.50. So I'll have a bit of excess at 155 figure level. So 155 figure level also correspond to the 50-day moving average, I think, as a resistance. So it's a zone, 154.50/155 figure level, short-term pivotal resistance zone for today. We'll flip to a intraday bearish bias for the dollar yen. First support level to watch out for will be yesterday's minor swing low here at 153.40. 153.40. Okay, 153.40. Below 153.40 exposes the next near-term support level at 152.80. Right. Only a hourly close above 155 figure level will invalidate today's intraday bearish bias on the dollar yen to see a further potential squeeze up, exposing the next intermediate resistance level at 155.85. Above it exposes 156.70 next, which is the minor swing high area of 16th of January and 23rd of January. All right, so i.e. using 154.50/155 figure level, short-term pivotal resistance zone, and potentially the hourly RSI is now showing signs of a short-term bearish momentum that could creep back into the dollar yen. So we'll be flip to a intraday bearish bias on the dollar yen using 154.50, 155 figure as my short-term pivotal resistance level. Okay, now onward next will be the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So Hang Seng Index yesterday, we do have a bearish bias, hoping for it to come down back towards the lower limit of that former minor ascending channel support, but price action going to break above our pivotal resistance level, which is at the 21,800 level, and we got to respect this price action over here, given that right now is showing signs of a bullish acceleration over here. That means this could be a very strong impulsive wave 3 in terms of Elliott wave. So this is the wave 1. It is the wave 1 over here. Okay, this is the wave 2. That means we have a very strong impulsive wave 3 extension that is going beyond the 1.618 and perhaps potentially going to the 2 times. Okay, at this point in time. All right. So with that, my first support level to watch will be today's yesterday's US session intraday low, which is at 21,940, but I don't put it so tight at 21,940. Use it slightly lower at 21,630, which is so the lower limit of this shorter term bullish acceleration minor channel that is in place since 3rd of February low. Flip to a intraday bullish bias stance above 22,470, which is the 1.618 Fibo extension level, and as well as this minor congestion area over here of 4th of October. The next resistance level to watch will be at 22,830 next. So 22,830 is this previous congestion area of 4th of April, and above it sees the swing high area of 7th of October, which correspond to the 2 times wave 3 extended Fibo target of the impulsive potential extension, the Fibo potential ongoing extensive impulsive wave 3 that we may be looking at it right now on the Hong Kong 33 price action. That will be the next resistance level at 23,120/23,270. Only an hourly close below 21,630 short-term pivotal support level for today will invalidate today's intraday bullish bias to kickstart a minor mean reversion corrective decline sequence, exposing the next near-term support level at 21,295, followed by 20,980/20,830 next. All right, so now with that, let us take a look at the Japan 225. So the Japan 225 also staged a bullish breakout from that minor sideways range configuration that was in place since the low of 3rd of February. All right, so we got to respect this bullish breakout as well. And right now, potentially it may float upwards next towards the upper limit of this medium-term complex range configuration that is still evolving since the low of late September over here, right? Since this late September low last year, it's been evolving in this kind of complex range configuration. And right now, the price action may revisit the upper limit of this sideways range configuration after the minor bullish range breakout that has taken shape yesterday. So using, because now the RSI is overbought, but there's no bearish divergence, so potentially there could be a minor pullback to revisit yesterday's so-called minor range resistance now turns into a pullback resistance zone, and also very close to the 20-day and the 50-day moving average, acting as a similar pullback support zone now at around the 39,110 level. So using 39,110 short-term pivotal support level, we will flip to a intraday bullish bias for any chance of any potential minor pullback that may take shape in the first place first. Then thereafter, the Japan 225 may expose itself towards the next intermediate resistance zone at 39,710/39,830. Above it sees 40,360 next in first step. Only a breakdown below 39,110 will invalidate today's intraday bullish bias to see reintegration back into the lower limit of this minor sideways range configuration, and that also suggests that yesterday was a bullish breakout failure. Reintegrate back below the next near-term support level at 38,770. Below it sees the lower limit of this sideways range coming in again at 38,380. Right, so that's for the Japan 225. Now, what's up next for the German 30 or the super Miro German 30, we call it. So the German 30 rally as expected. Yesterday, we do have a bullish bias, hit our resistance level right now as we are speaking, 21,385/21,480. Hourly RSI, yes, is overbought, but no signs of exhaustion in terms of positive momentum. It does not flash out a bearish divergence. So very likely there could be a chance of a minor pullback to revisit this former minor ascending channel resistance now turns to a pullback support, which correspond to yesterday's former minor swing high of 12 February. Both of them acting as a similar resistance at 21,135. So using 21,135 Titan key short-term pivotal support level for today, we will maintain that intraday bullish bias on the German 30. Next resistance level to watch 22,600 one-time Fibo extension, and as well as the next Fibo extension cluster at 22,800. Only hourly close and a breakdown below this Titan key short-term pivotal support level at 22,135 will invalidate today's intraday bullish bias to potentially kickstart a potential mean reversion decline scenario, exposing the next near-term support level at 21,970, followed by 21,746 next. So that's for the German 30, still maintaining the intraday bullish bias using a tightened key short-term pivotal support for today at 22,135. Now, onward next will be the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average, yesterday we do have a neutrality stance between 44,190 and this higher limit at 45,000 figure thereafter. So price actually managed to bounce off strongly from the lower neutrality limit, and right now it's trying to reintegrate back above the 20-day moving average, which is positive as well. So with that, with these two positive price action that was seen yesterday, intraday movement, we will flip to a intraday bullish bias for the US Wall Street 30, but taking things one step at a time. So 44,190 for sure will be our short-term pivotal support for today. First resistance level to watch will be this descending trend line, minor descending trend line that is capping previous price advance since the high of 31st of January, now acting as a resistance, intermediate resistance at 44,840. Only a breakout above 44,840 potentially revisit the current all-time high area that was printed in November last year at 45,090/45,100. Only a push down and hourly close below 44,190 will invalidate today's intraday bullish bias to see a mean reversion decline, to see a slight, I would say, to revisit the 50-day moving average that is acting as a support level, that also confluencing with the minor swing low of 27th of January and 3rd of February at this support zone of 43,840/43,730. All right, so that's for the German, that's for the US Wall Street 30, pardon me. Flipping to a intraday bullish bias using 44,190 as my short-term pivotal support for today. Now, onward next will be the Nasdaq 100. So the Nasdaq 100, yesterday we were bearish and it also hit our first support level at around the 21,460, 21,500 mark before shipping that strong bullish reversal, bouncing off from the 20-day and the 50-day moving average. And also right now, we also managed to break out above this minor descending trend line, former minor descending trend line resistance from the high of 23rd of February, now acting as the first pullback support level, okay, at 21,756. So I don't want to use 21,756 as my short-term pivotal support for today, because just in case of any whipsaw, I will use a slightly lower one at 21,600, which also correspond to the 20-day moving average acting as a support level as well. So as long as any potential minor pullback that may take shape during the European session and at the start of the US session thereafter, as long as it didn't surpass below 21,600, short-term pivotal support that I have for the Nasdaq 100, we will flip to a intraday bullish bias. Next resistance level to watch will be at this 21,945 over here, which is the minor swing high area of 23rd of January and 24th of January, above 21,945, potentially revisit the current all-time high that was printed in December last year, which is over here, right, 17th of December at 22,135 for the Nasdaq 100. However, a price action breakdown with hourly close below 21,600 will potentially indicate a failure bullish breakout yesterday, and price action may reintegrate back into this complex sideways range configuration again. In first step, looking out for the 21,400 level, a breakdown below 21,400 level potentially sees the complex range support coming in at 21,125, okay, which is also the minor ascending trend line of this complex range since the low of 13th of January. Okay, so i.e. We'll be flipping to an intraday bullish bias due to the positive technical element in short term that is being meteorized on the Nasdaq 100 yesterday, using 21,700 as my short-term pivotal support for today. All right, now onward next will be the commodities market. So let us start with the gold XAU/USD. So for gold XAU/USD, yesterday we do have a bearish bias. First support level it hit at 28,080. Okay, it didn't break below 28,080 and does not expose the next support level at 28,840, but instead it shaped a bullish reversal candlestick at our first support level at 28,080. And because of this bullish candlestick and where it shaped, it managed to shape at the pullback of this former minor ascending channel resistance. All right, over here, since it's a medium term ascending channel resistance from the low of 31st of December. So indicating that the bullish bias or the bullish impulsive sequence still remains intact after gold managed to survive at our first support yesterday, where we have a bearish bias. So with that, for sure, this will be our first support level to watch for today. Short-term pivotal support level. We will flip back to a intraday bullish bias for gold, 2880, 2880. First resistance level will be the all-time high area at 2940/2945. Above it, potentially sees the next resistance coming in, which is a Fibo extension cluster level at 2990/3000, which is also the psychological level as well. OD and hourly close and the breakdown below. Today's short-term pivotal support at 2880 will reinstate the potential mean reversion decline bearish tone scenario, exposing the next near-term support level at 2845. Below 2845 potentially sees the next near-term support zone coming at 2812/2795, which also correspond to the rising 20-day moving average as well. So that's for gold, given yesterday's bullish reversal candlestick right at our first support level, and this first support level will turn into a short-term pivotal support for today again at 28,080, and we will switch back to a intraday bullish bias for gold XAU/USD. Now, next up will be the West Texas crude oil. So for West Texas crude oil, what I could see is that yesterday price action clearly reintegrate back below the 20-day and the 50-day moving average. So this was the bearish candlestick that was formed yesterday, down negative 2.7%. And there's the daily chart of West Texas crude oil. So that was also in, we call it a catalyst by the breakthrough in Ukraine-Russia peace talk that may be on the near-term horizon. So on a short-term basis, over here, we will flip back to an intraday bearish bias because price action didn't actually bounce as expected to revisit the 20-day moving average that I think as the next resistance level to watch, and instead it just plummeted right through. So right now it's testing the first support level at 71 figure level at 7105. So given that the RSI is now in a grossly oversold level on an intraday basis based on the hourly RSI, there could be signs of a minor snapback rebound. So as long as this minor snapback rebound didn't surpass our 7250 short-term pivotal resistance that we have for today, we will flip back to an intraday bearish bias for West Texas oil. Next support level to watch will be 6980, the minor swing low of 27 December. Below it sees 6880 coming in next, which is the minor swing low area of 11 of December to 23rd of December. Only an hourly push up above 7250 will reinstate that mean reversion rebound scenario within this complex range configuration to revisit 7467/7516, which is also confluence with the 20-day and the 200-day acting as a similar resistance zone as well. Okay, so that's for West Texas crude oil. Using any potential snapback rebound that could take shape because of the grossly oversold hourly RSI. But as long as this snapback rebound didn't surpass above 7250 short-term pivotal resistance, we will flip back to a intraday bullish bias. We will flip back to a, pardon me, we will flip back to a intraday bearish bias for West Texas oil. All right. Apologies for the bit of tongue twisting. Okay, so with that, that also sum up our intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the economic calendar. What are the key data to look out for today? So for today, data will be more focused on the European or the Europe and UK region. So at 3 p.m. Singapore time today, we have the preliminary Q4 GDP growth rate for the UK economy at 3 p.m. that could influence or impact the sterling dollar and the sterling crosses over here. Then also thereafter in the 4:40 p.m. we have a ECB official speaking, ECB Singapore speech speaking as well. And after that will be the US session. We have the US PPI data at 9:30 p.m. 1 hour before the start of the US stock market that could influence the dollar and as well as the major US stock indices. That will be 9:30 p.m. Singapore time. So think this as a cost of business inputs, yeah, for the US corporation. So that's PPI. And thereafter will be a pretty much quiet US session. Okay, no Fed chair of Powell speech anymore. And yes, there's no other Federal Reserve official speaking. All right, so with that, that sum up today's daily dose of market insights. And I need to make an announcement. There'll be no daily dose for tomorrow as I'm away, and daily dose will be back again at a similar timing at 1 p.m. on next Monday. That will be on the 17th of February. So with that, I wish you all a great day ahead and a great weekend as well, looming into as we approach Friday tomorrow. And thank you, and we shall speak again on next Monday.